Well, my name is Andrea Mao, and I lead the accounting methods practice at Eide Bailly. Today we are going to be talking a little bit about some of the current developments, the hot topics that we're seeing in accounting methods right now. And the main topics we're going to touch on are some of the small taxpayer accounting methods. We finally have final procedural guidance as well as final technical guidance on those safe harbor methods. So some action items there. They did finally issue an updated list of automatic accounting method changes that have some procedural rules within them that are very, very helpful to us. We're going to talk about the leasing and fixed asset issues that we're seeing right now, and then some of the inventory and UNICAP items, and then finally looking ahead to the 2022 filing season. A few of the Tax Cuts and Jobs Act changes had a delayed effective date on those. Many of those are coming into effect this year. So we're going to talk a little bit about those issues as well as we start to, now that we've turned the page into the second half of 2022, I guess we need to start thinking about 2023. So as I said, the small taxpayer safe harbors, so these were part of the Tax Cuts and Jobs Act, and as long as taxpayers' average annual gross receipts are less than $26 million, they're eligible to take advantage of any or all or some of these safe harbors. The use of the cash method, exemption from UNICAP, the simplified inventory methods, where we're going to spend a lot of our time today, talking about what are, how do those methods work? What should taxpayers consider? What do they need to potentially do to move to a method that's consistent with the final rules? The exemption from the percentage of completion method for long-term contracts, and also the exemption from the interest expense limits under 163J. As of right now, as I said, for the 2021 filing season, the average gross receipts must be less than 26 million for 2018, 19, and 20. That number is indexed for inflation and is currently scheduled to go to 27 million for the 2022 filing season. So next year we'll be looking at years 2019 to 2021, but using a threshold of 27 rather than 26 million. So as I said, we did get the final regulations late in 2020 based on the issue date. They are effective or they're binding for tax years beginning on or after January 5, 2021. So which is why for most calendar year taxpayers, these are technically not required to be implemented for the current returns that we are working on right now. However, taxpayers can choose to early adopt the regulations. So they can choose to apply the regulations to the 2021 year rather than waiting until 2022. However, if they do choose to adopt one aspect of the rules, they have to adopt all aspects of the rules, which we'll talk about. There's some good news and there's some bad news, so something definitely worth considering. The two main issues that changed in the final regulations that we're going to talk about today, as I mentioned earlier, was the small taxpayer inventory methods. The IRS clarified for us what those methods mean, when's the deduction is allowable, what costs are required to be capitalized. So there are some changes there that some of our clients will need to make. The other thing they did is they modified the election to use prior year gross receipts. So on the prior slide, the small taxpayer accounting methods do not apply if you're considered a tax shelter. And so this election impacts your ability to potentially avoid being classified as a tax shelter. So as I said, tax shelter, any of those methods, so any of the methods, the small taxpayer accounting methods or the 163J limitation don't apply if you're a tax shelter. The definition of a tax shelter for these purposes is broader than a lot of people think about it. A tax shelter includes a syndicate, which is defined as a pass-through entity that allocates more than 35% of losses to limited partners or limited entrepreneurs. There is no definitions in any of these rules, unfortunately, for what is a limited partner or a limited entrepreneur. So there is some uncertainty around when, what level of activity is required to move you out of those categories. The other nice thing about this rule, though, is that you can only be considered a syndicate in a year in which you are allocating losses to those individuals. So even if all of the partners in an entity are passive, as long as that entity has taxable income and they're not passing out losses to those individuals, they can continue to qualify as a small taxpayer, which is where the exception and the elections come into play. So under the proposed regulations, taxpayers were allowed to make an election where they could use their prior year gross receipts to determine if they're a tax shelter in the current year. So for example, Assume you had a client that had taxable income in 2019 and a taxable loss in 2020. Well, absent this exception, they may become a syndicate in 2020, which would force them off of all of these small taxpayer safe harbors. Under the proposed regs, you could make an election to use your prior year gross receipts. So you could make an election and use the gross receipts from 2019 when you did have taxable income to determine your status as a tax shelter in 2020. The problem with that election was that it was forever binding, which effectively meant it only got you out of tax shelter status for 1 year. Because when we turned the page to 2021, it didn't matter if you had income or loss in 2021 because you were forced to use your 2020 gross receipts. Therefore, you would become a tax shelter in 2021 rather than 2020. So you're just kicking the can down the road for a year. The final regulations changed that election. So that election is now annual and applies only to the year that it's made. So if we go back to our prior situation, if you made that election in 2020 because you had a loss to pull in your 2019 receipts, you could wait to see what happens. And if 2021 is income, don't make the election in 2021. You get to use your 2021 receipts. And so you never have a period where you fail that test. So that was a very taxpayer favorable change. But then the question becomes, as I said, that was a component of the final regulations. Their proposed regulations provided for a different rule. So in order to apply that final rule, so for example, if you made that election in 2020 because you had that same fact pattern, income in 2019, loss in 2020, you need to revoke that election, and you do so by adopting the final regulations. So if you are so if you adopt the final regulations as they're required in January, for your effectively 2022 tax year, assuming you're a calendar year taxpayer, your election gets revoked automatically. You don't have to do anything. However, if you're wanting to early apply the final regulations, and this may be a very good reason to do so, the ability to change that election might be a good reason to revoke that election, then your process for adopting those regulations depends. So it depends if you are intending to make the election for the current year. So in other words, if you were trying to make a safe harbor election for 2021, then you would revoke your prior election through the filing of the new election. If you are intending to apply any of the other final regulation methods that we're talking about, filing a 3115 to adopt any of those automatically revokes your prior year election. If you're not making an election under the final regs, so in other words, you don't want to use last year's gross receipts because you had the fact pattern we were just talking about, you don't want to use last year, you want to use 2021, then we need to attach a statement to the return to make sure that we are revoking those elections for those prior years. So kind of a web, and the answer depends on where your facts fall and in terms of what are you trying to apply going forward and what do you need to do to revoke that. But that is a very important thing to keep in mind, is that election does need to be revoked. Otherwise, you're going to get stuck using last year's gross receipts, which is probably not your best answer. So what happens? So if I did get one question in here. Are all members of limited liability company limited partners for purposes of the tax shelter rules? Not necessarily. There are schools of thought that would say that if you are actively engaged in the business, either through working in the business, participation in management decisions, things like that, even if your liability is limited, if you are participating in the business, you potentially could be considered an active participant and exempt from those from the tax shelter rules. However, as I said, we don't have any formal guidance from the IRS, and I have not heard a word that they have any intention of issuing any formal guidance on that. So that's going to continue to be a facts and circumstances analysis. And we have had some clients who have looked to making more of their partners more active in the business to avoid those rules. But unfortunately, it's all gray. I can't tell you, this is an absolute yes or that's an absolute no. It's just a spectrum of your level of participation in the business. So as I mentioned, if you're going to adopt any component of the final regulations, you have to adopt everything. So if you want to adopt the new tax shelter election, you also need to adopt all all of the small taxpayer inventory all the small taxpayer methods, including the inventory methods as articulated in the final regs. And in the context of inventory methods, there's really two components to these safe harbors. The first component is which cost do I really need to capitalize on my financial statements for inventory? The second is when do I deduct the inventory? So effectively, part of it is quantifying costs and part of it is a timing issue. All three of these methods, regardless of which one you choose, provide you some level of safe harbor in terms of the cost. So in the under that first area, all of these methods provide a benefit because they reduce the cost you need to include. Only one of these three can potentially result in an acceleration of your inventory deduction, and that is the non-AFS 471C method we'll talk about in a minute. But even though the other two methods don't accelerate the deduction, they are still valuable in terms of limiting the number of costs we need to capitalize for tax purposes. So the non-incidental materials and supplies, they refer to as the NIMS method. In applying that method, the only costs that are required to be capitalized are direct materials costs. So you can exclude indirect costs such as shipping and duties. You can also exclude labor from your inventory balance. In the IRS's view, direct labor is typically required to be capitalized. By choosing this method, we can avoid doing that. So we're really just looking then at the invoice price of those inventory items, and then that is what is going to go on your balance sheet. Unfortunately, under this method, as clarified by the IRS, both in the prior proposed regs and the final regs, they do not believe that items are used or consumed until they're transferred to a customer. So as the method is articulated, the deduction occurs, so it runs through cost of sales when they are used or consumed, which is when they are transferred to a customer. So we really don't see much of a benefit here in terms of timing the inventory deduction. The only benefit here really is the ability to limit the total costs that get capitalized to your inventory balance on your balance sheet. The other thing that they clarified is that if you're going to use this method, you need to use a FIFO or specific ID and an average cost method. So that tells you which items you have left on hand. So if you bought 50 and sold 40, those methods will tell me which 40 I sold. What were the cost of the 40 items I sold versus the 10 items that I did not. The main clarification there is no LIFO. You do not get to use a LIFO method. You have to select one of those methods if you're planning to use the non-incidental material and supply method. The second option is the AFS 471C method. So AFS stands for an applicable financial statement. That is defined the same way for this rule as it is for like the 451B and 451C rules and a number of other provisions in the TCJA. An applicable financial statement is an audited financial statement. A review is not considered an applicable financial statement. It needs to be a full audit or a financial statement that's required to be filed with a government or regulatory agency. An example we often see there are banks. Banks typically have a regulatory reporting requirement. Their financial statements need to be filed with the state or federal banking authority in their jurisdiction. So they typically fall into having an applicable financial statement, but any other taxpayer who just hasn't reviewed financial statement is not considered to have an AFS, and so technically would not be eligible to use this method. In this case, the way the method works is we get to follow the book method for determining which costs are capitalized to inventory. So the book rules are similar to the tax rules in terms of which costs need to be capitalized, but they are in many cases narrower. So following the true book method rather than the tax method if you follow all of the rules under 471, your book number may very well be smaller than your tax number. And there's also, obviously, for those of you who've done returns, you realize that there's also a significant time impact in that of figuring out what are those book tax adjustments. That takes that requirement off the table. We don't get to accelerate the deduction because we're going to be deducting the inventory the same time as they are for book purposes. So the main benefit here is the ability for us to say, you know what, we're following book. I'm not going to worry about what the tax rules might require me to handle differently. I'm just going to follow book. I'm going to use the same balances. I'm going to write it off when book writes it off and call it a day. The other sort of interesting aspect of this is that we can then follow the book determinations on materiality. Often we talk to auditors, they say, we didn't bother to do that, it was immaterial. We didn't add those costs. We weren't worried about overhead. Technically, that's never really an out for us on the tax side. The IRS does not have a materiality threshold or materiality requirement. So by adopting this method, it does allow us also to leverage the book determinations on whether something is material needs to be taken into account. The third method, so this is the only method that can potentially result in an acceleration of the timing of the inventory discussion. And the non-AFS 471C method is defined under the regulations as the method of accounting used for inventory in the taxpayer's books and records that reflect their business activities for non-tax business purposes and are prepared in accordance with taxpayers' accounting procedures. What does that mean? Theoretically, what that means is if we get to a position where we are willing to write those off for book purposes, so we can craft a policy that pretty much says whatever we want, as long as it is the method that we're using for non-tax business purposes and is consistent with the inventory records that we are using with our balance sheet and the inventory records that we're using for other purposes. And in a second, we'll talk about some actual examples of what the IRS has said is okay and what is not okay. So this by far has the most flexibility in terms of drafting. It does require policies, and I would strongly recommend that those policies be in writing, because that will clarify for the IRS where we are drawing the line. This is what we are going to capitalize. This is what we are not going to capitalize for tax purposes. So this does allow us to impact both components of the inventory adjustments we were just talking about. We can adjust the cost capitalized, and we can potentially accelerate the deduction of those costs. So then the question is, okay, well, what is required, or what is required in order to qualify for a current deduction, and what sort of activities are going to force me to put this on my balance sheet? So the main rule is we cannot reflect our inventory for any purpose on any balance sheet of any kind if we're going to deduct it, if we're going to accelerate that deduction for tax purposes. The IRS illustrates through examples in the regulations that you can maintain an inventory system that shows you how many widget A's you have left and B and C for purposes of reordering. So it can show you what you have on hand from a quantity perspective. You can continue to do physical counts to confirm that that is in fact the quantity that you have on hand. However, you cannot show that inventory as an asset on your financial records for any purposes. It doesn't go as Schedule L on your tax return. It cannot go on a financial statement. It cannot be provided to a bank or another lender saying, nope, this is what we've got for inventory. It has to disappear entirely from your financial records if you want to accelerate the deduction. So the good news there, a lot of people were concerned that they weren't even able to maintain quantity counts. So the good news on that is we can do that, but that's pretty much it. We can't get any farther than that. In the examples of the regulations, they illustrate the opposite scenario. So in that case, they highlighted that the taxpayer had an inventory system, but then they actually associated specific costs with those items. So they said widget A, $50 per widget, widget B, $30 per widget. And so they had an idea of what their total costs on hand were, not just total quantity, total costs. That caused them to not be allowed to accelerate the deduction because the acceleration was not consistent with the method that they were using in their books and records. And as I said, your inventory cannot show up anywhere even for internal purposes, internal planning purposes, internal reports, nothing. If we want that deduction to be accelerated, we need to make sure that that inventory has fully disappeared. So taking those two issues into account, should I consider early adopting the final regulations? And I think the first question there is, do you need to revoke or change a gross receipts election? If you do, in order to be, to avoid being classified as a tax shelter for 2021, I think that would be a very good reason to choose to adopt these regulations for 2021. Another thing to consider is whether this will result in a favorable or an unfavorable change. So for example, I know we had a lot of clients who wrote off all or significant portion of their WIP and finished goods inventory balances under a slightly different analysis than what was provided in the final rules. And depending on what method they would like to apply going forward, they may need to add that back, which would be an unfavorable adjustment and increase to taxable income. And then the question is that will likely get us a 4-year spread. So do we want to start recognizing that in 2021? How are we sitting from a taxable income perspective in 2021? What are we projecting for the future? Because we will be forced to spread that over 4 years if the adjustment is larger than $50,000. We do not have an option to elect to pick up that entire adjustment in the year of change. So again, something to think about, when do we want this income? If this is going to generate income, we can kind of do estimates, back of the envelope calculations on this is what we think the adjustment would be for 2021 versus 2022. How does that play into your taxable income planning? And then the other thing to keep in mind is there anything you want to do now to help you apply one of these methods going into 2022? And the main one there, I think, is the non-AFS 471C. If you're thinking, I think I really want to do that, but I really don't have any inventory policies right now. I really don't. I've got those numbers flowing through a lot of different places. Do I really want to, do I really want that off? And if I do, I want part of it off? Do I want all of it off? How do we handle that? That's something to think about this year, so that you're in a position then going into 2022 to say, yep, I'm going to follow my 471, my non-AFS 471C method. I'm going to write these off, and here are my policies that articulate how I've decided how much I'm going to write off. So those are the technical considerations related to the small taxpayer changes. We did finally get updated automatic method change procedures. So RevProc 2022-14, this is the first update we've seen of the automatic change procedure since 2019. Originally, the IRS had indicated that was something they were planning to reissue every year, but then, kind of fell off the rails there for a couple years. So they're back to it. They got one out this year. They're a little wishy-washy on whether they think there'll be another one next year, but at least it does put in one place all of the new automatic changes that have come to light since 2019. So all the QIP related changes, the bonus reg changes, the changes related to the small taxpayer safe harbors, revenue recognition, all of those things that are new since 2019 are now incorporated in one place in 2022-14. So that's kind of nice, at least. You don't need 5 RevProcs anymore to track down all of those things. And we're going to highlight here some of the changes that were made to automatic, to automatic changes available, but then also to some of the procedural rules. There are some, this isn't not a complete list of all of the changes that were made. I strongly recommend that if you're using a template or relying on a prior example for purposes of preparing a current 3115, I'd recommend checking the section of 2022-14 to make sure that none of the specific requirements have changed. Like, for example, in this last one, the change 233, the change to the cash method, originally when that came out under the TCJA, they waived the requirement to attach prior year financial statements. So we filed all those 3115s and didn't have to include that. Well, that safe harbor's gone. Now those financial statements need to be attached to that change. And that is, again, it's maybe not a huge change from a technical perspective, but certainly from a procedural perspective, you don't want to get burned on a foot fault of not realizing that that rule or that safe harbor had evaporated. Unfortunately, the other thing they did with some of these small taxpayer changes is they added new ones, which just made it more complicated for us to figure out which change we should file in which years. So the new change 257 is a change in a mandatory 448 year, meaning that is the year that you've exceeded the small taxpayer threshold, or that's the year you become a tax shelter. The change number you need to use for that change is 257, and there's a reason for that we'll talk about in a minute when we talk about the scope limitation waivers. It's very important to know, is this mandatory or is this optional? The 447 rules related to farmers, don't file a lot of those. So the 258 change is used for that. And 259 actually clarifies a question I got a lot of when we were filing these back in 2018. They said, well, if I'm gonna, normally if I go to, go off of an accrual method to a cash method, I don't have any inventory. So how do I make this change but leave my inventory on? Because the inventory is covered by the 471C changes, not really by this change. So that doesn't make any sense. And it's right, it didn't make any sense. So what the IRS chose to do here is they clarified that a taxpayer that's using the accrual method for inventories only, nothing else, no other income or expenses, using accrual method for inventories and cash method for everything else is considered a cash method rather than a hybrid method. Typically, a hybrid method is where you've got some income on cash, some income or expenses on cash, some on accrual. So you've got kind of a mixed bag. The IRS said, in this circumstance where that's the only thing you have on accrual, we're going to assume that you are on the cash method. So a nice clarification there that will hopefully help taxpayers understand that a little bit better. The 233 change, as I mentioned, the interesting thing they did with that one was, so there's a change for long-term contracts. You can change off of the percentage of completion method. And when you do that, you have options as to which method you move to. You could move to the completed contract method. You could move to a standard accrual. You could move to accrual excluding retentions, or you could move to cash. All of that was covered under the 236 long-term contract change. Now the IRS has changed that. If you're changing your long-term contract method to cash and only cash, you use 233. If you're moving to any of those other safe harbor methods, it stays under 236. So not entirely sure why they did that, but that change moved. The inventory changes. So these are the changes that would be necessary to move to a small tax to an inventory method that conforms to the final regulations. So the first change 260 is if you're moving to the non-incidental materials and supplies method. So you're moving to the method where you're capitalizing only the direct materials costs and you're deducting them as they're used or consumed, i.e. transferred to a customer. That's what you're moving. If you're moving to that method, then you file 260. If you're moving to either the AFS or non-AFS methods, it's 261. Don't know why, but they split those changes up. The other big thing here with the inventory changes is, a lot of taxpayers said, well, what I'm doing, if I filed a 3115 in 2018, my description wasn't really what it says in the final rules, but I'm getting to the same answer. So do I really need to do a 3115 just to go from A to B with no adjustment? And the IRS said, okay, fine, no. If you're moved from your current method to the method you want to use that conforms to the final rules, results in no 481A adjustment, you don't have to file a 3115. But that's only if your 481A adjustment is 0. So for example, as we talked about those taxpayers who deducted their WIP and finished goods that may or may not be able to or want to move to a non-AFS method and will have a 481A adjustment, will need a 3115. It's only if we are moving, only if we don't have a change in our, effectively no change in the inventory balance, because that's our 481A adjustment is going to be a change in the inventory balance from old method to new method. So there's no change to our inventory, then no 3115 required. However, I recommend, even if no 3115 is required to be filed with the IRS, that there's something in the client file or taxpayer file that says, this is what we're doing. This is how we decided we are going to be applying the non-incidental material and supply method. And just to clarify what you're doing in case the IRS asks, because the IRS could come in and say, well, so just describe for me your method. You're like, well, I guess I'm following book. Well, are you using the AFS 471C method? Are you using a non-incidental material and supply method? That's definitely something worth documenting and documenting the rationale for why there is or isn't a change from the book number to the tax number. So I would strongly recommend that you go through the process of documenting this, even if we don't have to officially file a 3115 with the IRS. In addition to those items, the IRS gave us 2 new inventory changes that apply if you're already using a small taxpayer inventory method. So 262 change is a change within a small taxpayer inventory method. So for example, as we mentioned, we were talking about the non-incidental materials and supplies. You have to identify those using FIFO or average cost or specific ID or something like that. Well, if you want to move from FIFO to average cost, that is a 3115. Because what we're doing is we're changing the way we're identifying the inventory items that are left on hand. We're still using the non-incidental material and supply method, but we've changed sort of a sub method underneath that. That is an accounting method change, and that requires a 3115. This is the change that we would file for that. The other thing, and this has been a point of irritation between taxpayers and the IRS for some time, in the IRS's view, if your method is that you're following your applicable financial statement and your method in your applicable financial statement changes, you have to file a 3115 because your tax method is changing. Even though under the old, you would say, my current method is I'm following my books, my proposed method is I'm following my books, is just that books moved, basically. Books moved the target. So therefore, I'm required to file a 3115 with the IRS to notify them that I've had a change in, if I'm following my AFS, I've had a change in that, or I've changed my underlying accounting policies so that I'm changing the timing or changing the cost of those deductions. We need to know when those occur. We need to know when book is changing their method. We can't just blindly follow them forever. We do need to make sure we're understanding when they're making changes, because the IRS does believe that is an accounting method change and does require us to file this automatic change in the event that that would occur. The other change, 263, so this is a change from the small taxpayer to a normal inventory method. So this would be the change when you go above the $26 million, when you become a tax shelter, when you decide you don't want the small taxpayer methods anymore for one reason or another, then that's the accounting method change to go back to a quote unquote normal or standard inventory method under 471A. One of the common questions that I got was, well, normally under the normal automatic change rules, you cannot request the same automatic accounting method change twice in a 5-year period. So if you file a change for 2019 and you want to change that back for 2022, 2023, something like that, that becomes a non-automatic change because it has not been 5 years since the last time that you changed that. So the question that came up was, well, okay, so what if I'm sitting right around 26 million? Like this year, my average is 25 and a half. Next year is 26 and a half. And then I'm back to 25 and a half. Can I keep going back and forth between the two methods? Because I'm going to have huge issues with my 5-year scope waiver, right? Because I can't do that every year under the normal rules. And so the IRS gave us a little bit of relief, and the key to understanding when we get relief is whether that we're making the change in a mandatory year or an optional year. So we have, in the year that we fail to be a small taxpayer and we are required by 448 to change back to a non-small taxpayer method, we can make that change regardless of what other changes we've requested in the last 5 years. So even if we filed a small taxpayer change in 2018, now we want to go off of that method because we've crossed that threshold, we can file that even though we're within 5 years of when we moved to the small taxpayer method in the first place. So the most important question is going to be, is this the first year you failed? Because it's only the first year that you get that waiver. So if you made a mistake in the gross receipts calculation and it turns out they actually failed in 2020 and not in 2021, technically 2020 was your mandatory year. So therefore, not filing it in that year does require us potentially to file a non-automatic change because we don't get our scope waiver. The other thing is we can ignore any of those changes that are made in mandatory years if we want to go back to the small taxpayer method. So as long as we've made the change off of the small taxpayer method in a mandatory year, we don't need to consider that a change in the future. When we're looking to see if we do qualify again, we can disregard that, go back to the small taxpayer method as an automatic change. Does not matter. The other nice thing we have right now is we have sort of a freebie for the 2021 and 2022 filing seasons. Our change to move to the final regulations, whether that's through early adoption or in 2022 when they become effective, we get a waiver for that. So like this is something we need to address in 2021 or 2022 because that waiver does have a deadline on it. The other ones do not. I mean, the mandatory versus optional distinction does not ever really, at least right now, does not have an expiration date. So that's always something that's going to be relevant. For the next 2 years, however, we're probably going to be relying on the change to adopt the final regulation waiver, and that door is going to close on us after 2022. The other thing that they addressed is accelerating the unfavorable 481A adjustments, because there was a way to whipsaw the IRS on this, which they apparently figured out and decided to close that door. So as I mentioned earlier, anytime you have a 481A adjustment over $50,000, you have to spread it over 4 years. So if in this case, if we assume that a taxpayer didn't qualify as a small taxpayer in 2020 and had to go back on UNICAP, so they have an unfavorable adjustment of 100,000, so they pick up 25,000 in 2020, 21, 22, and 23. Well, 2021 comes around and I'm no longer a tax shelter, so I'm not subject to 263 anymore. And gosh, my capitalized costs are 150,000 now, and since it's a favorable adjustment, I'm going to take that whole thing through my 2021 return. And without this special rule, all I would have had to do was pick up 25,000 of the other adjustment, meaning that effectively that last 50,000 of the adjustment, I took a deduction for it before I ever paid tax on it. I took the benefit back before I had actually paid tax on the initial adjustment, and the IRS said, well, I don't think that's fair. If you're going to change back to one of these methods and you have an unfavorable adjustment yet to be recognized, that all gets accelerated into the year you change back and net against your favorable adjustment. So in this case, that last $75,000 of that adjustment is going to offset the $150,000 favorable adjustment. So we don't get the deferral and time value of money that we used to. Again, logical, makes sense, but something to keep in mind when you're planning ahead. You aren't going to have that extra 25,000 in income in those 2 years. You're going to end up having less benefit in the year that you change back. All right, enough small taxpayer talk. On to other inventory and UNICAP issues. So anyone really involved in any industry or going to Target even lately probably realizes that there are all sorts of product shortages everywhere. There are supply chain issues. There's no inventory available for sale. Auto dealers are definitely seeing this perhaps more than some other industries. There just aren't new cars on the lots. You go over, you look at the lot, there are no options because of some unfortunate carryover impact of the COVID pandemic. So what happens if you're on LIFO? So the benefit of LIFO is, right, that you're deducting your most recent purchases against your cost of sales. So in order to, your LIFO reserve is basically the amount of income you've been able to defer based on the inflation in your underlying inventory over the years. And as long as your inventory balance in dollars keeps going up, you get to maintain that deferral. Well, when your inventory does not go up, then you have to go back and start recapturing that deferral. And we've seen situations for some of our auto dealers where because their inventory was so low or potentially almost zero at the end of 2021, they're having to recapture a lot of their LIFO reserve, which is generating a very, very significant tax liability. And there is a section in the Internal Revenue Code 472 that I don't actually know the history of why it was put in there. The point of it, though, is it allows LIFO taxpayers to several years to replenish their inventory levels and avoid the recapture where there are certain international trade related or economic related issues that have caused them to recapture that. And what that does is it basically says, okay, you don't need to worry, you don't need to recapture all of this. We'll give you 3 years to get back to where you were, and only the difference between where you are at the end of that period and where you were before is your recapture. So it certainly gives us a lot more time to try to get our inventory levels back up to avoid that recapture. The Treasury Department and apparently Congress have determined that 472 does not apply to the COVID pandemic for one reason or another. Again, not entirely sure what the rationale for that is. So they are working right now on proposed legislation that would attempt to create a similar benefit for taxpayers, basically giving them an extended period of time to replenish their inventory. Right now, the proposed legislation technically only applies to auto dealerships. So any other businesses, manufacturers, implement farm equipment dealers are not covered. There have been some there's been some movement by different groups to try to expand the scope of that relief. Who knows where this goes? Does this even pass? Nobody knows right now, unfortunately. I think the only thing we can probably say for certain is probably whatever happens is not likely to happen before the extended deadline. So we are in a situation where the 2021 returns probably need to be filed before we know for sure if this relief is going to be available. So if we don't get this relief from the IRS, what are the options? Well, if we don't make to the change to, we just stay the course, stay on our existing LIFO method, the entire portion of the recapture is going to have to go through the 2021 return. So for example, if if your inventory is 0 at the end of 2021, all of your LIFO reserve is going to come into income on your 2021 return. Your other option is to file a 3115 to move off LIFO. Go back to FIFO or average cost or something like that. That would allow you to spread your reserve over 4 years, so it reduces the hit in 2021. You'd spread that over 4 years. However, you cannot readopt LIFO for 5 years. So you have to commit to being on a non-LIFO method for at least 5 years before going back to LIFO. We've had some clients do that, but some have chosen to stay the course. The IRS and Treasury have hinted that they are working on procedural guidance that would help taxpayers implement. If this safe harbor passes Congress, that would help taxpayers apply that retroactively. So it's possible that, even if you recognize all that income on your 2021 return, if this relief is eventually granted, we're expecting that the IRS is going to provide us a mechanism to take advantage of that. What that mechanism will be, we do not know. The IRS, and that may or may not cover the ability to revoke 3115s. And we have raised to the IRS and Treasury the issue that a lot of people, if this legislation had been issued, a lot of people who changed off LIFO would not have, because they would have said, you know what, I'm going to wait my 3 years. I'm going to see if I can recover. I don't want to give up on LIFO just yet. So it's possible that whatever relief they choose to give us will also allow us to potentially revoke any 3115s that are filed. We have no idea. That's not, it wouldn't be the first time the IRS has done that, but it isn't something that they do a lot of. So it still leaves us in a bit of a bind for the 2021 filing season, but just something to keep on the radar. And we'll certainly certainly let you know as we hear more in terms of whether that passes, what the procedural rules might look like. We'll keep you in the loop. We'll be sure to share what we are hearing. The other big issue we're seeing in the inventory space right now are the 263A regs. So those were passed in the end, I believe, the end of 2018. And what they did was they clarified a lot of the rules around. So 471 inventory are your direct and indirect costs. That is, a lot of people consider that to be sort of synonymous with book accounting, but isn't exactly the same, because there are some things we're capitalizing under 471 that they're not, and vice versa. So what it did really is clarified, okay, here's your 471 bucket. These are the costs that go in there. These are the costs that go in your inventory bucket. And it also, at the end of the day, what this requires is that we know what's in those book numbers, so that we know, okay, here's my list of costs that have to be in my 471 tax number. Here's the list of costs in my 471 book number. And do I need to make adjustments so that I can get my book number to match my tax? Maybe it's adding costs, maybe it's subtracting costs. How do I get to that number? It also clarified that if clients don't have an audited financial statement, they are required to use tax basis numbers in their tax inventory calculation. And so if you think about some of the big book tax differences like depreciation, book may very well be capitalizing book depreciation, but in a year where a lot of equipment was purchased and deducted under bonus depreciation, our tax depreciation number is a lot higher. And the IRS has clarified that we have to use that higher tax basis number unless we have an audited financial statement. If we have an audited financial statement, we can follow book. If we don't, we need to start allocating those Schedule M adjustments into our inventory. There are also some detailed rules around allocating cost variances. So a lot of book inventory methods are based on, overhead is $50 per direct labor hour. So multiply that times labor hours and ending inventory gives you a number, and that's what you assume is in ending inventory, and then you calculate all the costs that should have been in there, and then the difference between your actual costs and what you actually applied becomes a variance. And there are rules for how that needs to be applied for tax purposes. Some safe harbors, but not that are not going to be helpful to everybody. So there are some complex rules in there around allocating those variances. The biggest thing, and the thing a lot of people talk about, is the new modified simplified production method. And what that allows us to do is compute different absorption ratios for raw materials versus work in process and finished goods. We can reduce the costs that are allocated to raw materials inventory. So we've actually seen a number of very favorable client changes for this because they have a large raw material inventory balance. Most of the 263A costs that we're having to add in relate strictly to production. So we're applying those to a smaller number than we were historically. So definitely something to keep in mind if you have a large raw materials balance, because there is some benefit there potentially. The fixed asset and leasing issues, it seems like every year there's something on the fixed asset area that we need to be filing 3115s for. Just seems to be the trend lately. The QIP change, so the correction in the CARES Act to move that from 39 years to 15 years, filed a lot of those last year. I know a lot of people addressed that last year. There were some assets that fell through the cracks. That is still an automatic 3115, still the same change number. No big changes there, so something we can continue to fix for 2021. The residential rental property, originally for the taxpayers who elected to be exempt from 163J, they had to move their residential rental property, non-residential real property, and QIP to ADS. So they said that the ADS recovery period for assets placed in service before 2018 was 40 years. So all those assets went from 27.5 to 40. Assets placed in service in 2018 or later went to 30 years. So then it went to 27 to 30. The end of 2021, they passed the Appropriations Act, and in that they changed the recovery period to 30 years for everything. So we need to go back and file those changes. Those are technically filed under DCN 288, the change in use. And the big trick with those is the 481A adjustment, because we're still not going back to the date it was placed in service. We're just going to the date of the 163J election when the change in use occurred. And this change from 40 years to 30 years only applies to this group of taxpayers. So if you were subject to ADS for any other reason, all of your pre-2018 assets have to be at 40 years. It's only if you made this election that you get the benefit. They also, actually within the last couple months, provided an ability to make it a late election out of the Indian recovery period. So there's shorter Indian recovery periods under 168J. That is an extender, and because of a late extension, it was extended after a lot of people filed returns for that year, so they didn't have the opportunity to elect out and use the longer recovery periods. We don't see a lot of people making this election, but if you do want to increase your taxable income, this would be an option. You could make a late election to go out to not use those shorter recovery periods, and then reduce your depreciation, increase your taxable income. Also on the fixed asset front, leasing. This is a big issue that is starting to trickle down to our client base, to non-publicly traded clients. There's a new GAAP standard, ASC 842, that is going to require all leases or most leases to go on the balance sheet with the right of use asset lease liabilities. But for our purposes, what this is going to require on the audit side is that they collect and summarize the terms of all existing leases. And that is a gold mine of information for us on the tax side, because typically the tax rules for leasing differ from the book rules. So we have a lot of situations where we should have book tax differences, and we may or may not. We might have the wrong amount. We may not have a difference at all. So the fact that the auditors are going to all the work to identify and pull all these leases gives us a great opportunity to review and update the tax treatment. The two big issues on the tax side are the classification of the transaction. So is this truly a lease or is this a sale or financing transaction? It gets confusing because the auditors think there are two kinds of leases. There's operating and there's capital. And in both cases, they still think they're leases. In our world, it's either a lease or it is not. And if it is not a lease, it's a sale or financing transaction. At the end of the day, we get to the same overall taxable income. So all the same amount of income or deduction. It's just that the timing differs significantly, especially due to depreciation and accelerated depreciation for equipment assets. We also use very different criteria for making that determination. So following what's being done on the book side may or may not be leading us to the correct answer for tax purposes. Similarly, the recognition of lease income and expense on leases that have increasing or decreasing rents, deferred rents, prepaid rents, the book accounting for that often does not match the tax accounting. We saw a lot of COVID-related lease modifications that went unnoticed, I think, on the tax side, that could have resulted in us accidentally reporting those leases incorrectly. So they said the classification of a transaction as a lease or not a lease is a facts and circumstances analysis. We don't have any bright line tests like they do on the financial reporting side. So the financial reporting side, there's 5 or 6 criteria and they walk through each of them. And if they fail any one of them, then they're capital. And that's it. That's just the end of the analysis. For us, we have to look at all of that. We have to say, well, we've got 4 in favor, we've got 2 not in favor. We got to weigh those against each other and say, I think even though there's only 2 factors here, I think they're more significant. So I think we're going to go that way instead of classifying it consistent with the other factors. So there's really no shortcuts from our perspective, and nothing is changing on our side. There's no change to the factors, to the analysis, to any of that. It's just that what we're starting with on the book side is going to be changing. And we need to be aware of what is getting recorded on the book side to make sure that we're making the proper adjustments for tax purposes. So the leases with increasing or decreasing or prepaid or deferred rent, we typically refer to these as 467 leases because that's the section of the code that governs the rules here. So we see this a lot where there are balloon payments. So it's maybe no rent in year 1, 2, and then at the end of year 3, it's the whole thing. All that cash gets paid at the end of year 3, or the opposite, it all gets paid at day 1, year 1, and covers 3 years of time. Typically what's going to happen to those on the GAAP side is that they're going to straight line that lease or straight line the rent over the term of the lease. So they're going to say 1/3, 1/3, 1/3. And that might be the correct answer for tax purposes, but often it is not. In a lot of cases where it is just a simple lease where it says, starts at $100 a year, increases by 5% every 2 years, and it's a 10-year lease. So it's, in just stepping every 2 years, book is going to straight line that over the term of the lease. We, on the other hand, might be able to continue to follow the lease agreement. So we would do 100 in year 1, 105 in year 2, 111 or whatever in year 3. We are much less likely to have to straight line that rent than they do on the GAAP side. So if you see a prepaid rent or deferred rent on the balance sheet, that's definitely something we need to be asking about because that may very well be something that shouldn't exist for tax purposes, and we should have a Schedule M for that. If we do catch that, that's an automatic change. So not the worst thing in the world to get our 4-year spread if it's unfavorable, which often they are. So we can fix that, but we need to make sure that we're watching for those because those happen quite frequently. So as I said, scheduled TCJA changes. So as you recall, in the TCJA, there were a number of expiring rules. There were rules that came into play that sort of appeared out of nothing several years down the road. There were scheduled phase downs. There's years and years and years worth of changes in that. The first one is the bonus phase down. So assets placed in service on or after January 1 of 2023 go from 100% to 80%. And even though we spent 5 years at 100%, our step down is annual. So it's 60% in 24, 40, 20, and 0 is how it is scheduled to go. So the key here is going to be placed in service dates. When we get to December, there's going to be a big difference between getting something in service in December 31 and January 1. So I think we can also expect the IRS to be paying attention to placed in service dates because they know this too. And so we were looking for its, a condition or state of readiness for its intended use. That's the standard. So if that requires some acceleration in processes to make sure we can get there by the end of the year, or maybe we don't want 100% bonus, maybe we do only want 80, then we're going to want to hold off and not place those assets in service in 2022. So again, something to keep in mind as we're nearing the end of 2022. There's also there's a change in the 163J interest expense limit. So the limit is calculated as business interest income, 30% of ATI or adjusted taxable income, and then floor plan financing. Well, the definition of adjusted taxable income is scheduled to change starting in 2022. Historically, we had been using an EBITDA number. In other words, we used our taxable income and added back interest, depreciation, and amortization. So for all of us who are taking advantage of bonus depreciation, that was very significant. We were in a taxable loss, but by adding back our depreciation, we have income, and we can use that income to absorb interest expense. So it was great. That goes away. Is there scheduled to go away and go back to EBIT starting January 1, 2022. There is a very, very significant lobbying push to delay or eliminate this requirement. So we are still in the same place in 2022. Again, TBD, we haven't seen any movement on this. Who knows when it would move? If it would move before the end of the year or not. So I know a number of people have been trying to work through provisions and sort this out. Is a headache because as of right now, you might have a 163J limit, but if they change the rules, you may not. So again, stay tuned. We're going to keep our eye on that. We've got Mel and Jay in DC who are telling us what they're hearing, and I know the National Association of Manufacturers is very involved in this. So maybe we'll see that move. The other big one, so R&D and software costs. Currently, we have the option of either currently deducting them or capitalizing. Typically, starting in 2022, assuming nothing changes in the law, all R&D costs are going to have to be capitalized and amortized. US-based activities capitalized, amortized over 5 years, non-US activities over 15. This is going to apply to 174 costs as well as software development costs. So I know many of you right now are probably aware that there's technically 2 different sets of rules for those costs, even though they're kind of sort of interchangeable in a lot of people's minds. It doesn't matter how we classify it or which provision it's under. If it is considered an R&D expense under 174, it's going to have to be capitalized and amortized. We have asked the IRS to provide clarification on what is a 174 cost. So those of you who've done R&D studies probably know that a lot of the costs for those studies are wages that might be showing up as a 162 expense or supplies that might be a 162 expense. Well, technically the IRS is going to, assuming that if this stays as is, the IRS would potentially force us to go in and reclassify all of those items to 174. So we're applying this method correctly. So we have said, all right, if you want us to do that, then we need better definitions. They acknowledge that and they say they're working on it, but don't know when that's going to happen. And you're wondering, why on earth is Andrea talking about this? Because she doesn't do R&D work. That is absolutely right. The reason that we are talking about this is the IRS has been very clear that they believe that if this limitation does come into play, it would be an accounting method change. So we would need to file a 3115 to move from our current method to the proposed method. And that is something that we are definitely keeping an eye on that, because I realize that is going to impact a lot of people. If this doesn't move, we're going to potentially have a lot of 3115s to file. And so who knows what happens with any of these rules? The thing to keep in mind is that all of these have a cost. When they passed the TCJA, they said it was only going to increase the deficit by X dollars. And that was based on all of these provisions, all these income add back unfavorable provisions coming in to offset the loss in the earlier years. So if these are going to get extended or they're going to get abolished, they need to be paid for. And I've heard some say that they think that it's most likely that some of these just get delayed a couple years, at least now. It may just be similar to what the R&D credit used to be, just wait a year, oh, out of time, delayed another year, oh, out of time, delayed another year. Who knows? We may not know anytime soon whether any of these things are going to come to fruition, but those are things we have to make sure we have on our radar as we're rolling into 2022 planning season. With that, I think we went over by a minute, but if you have any questions, feel free to reach out. As I said, you'll probably be hearing more from us as the time passes, and hopefully the next time we'll have some answers to these questions. Who knows?